I think it's safe to say that the cryptocurrency bull market is in full swing. This is as exciting as it is terrifying, because now you're going to get cornered by a bunch of questions, including when you should sell, when you should buy, and how you're going to cash out in a tax-efficient way. During times like these, understanding technical analysis is more important than ever. Even if you do not plan on actively trading, getting familiar with a few common price patterns, technical indicators, and other critical metrics will go a long way in helping you sniff out buying opportunities and estimate when to sell your bags. My name is Guy, and today I'm going to examine a few of these common price patterns, technical indicators, and other metrics that will be useful to you regardless of if you're a Wall Street Bets YOLOer or a hardcore hodler. And I'm going to explain them all in plain English, plain British English to be exact. Before we break out the trend lines, I have to give you the bottom line. I am not a financial advisor, and nothing in this video should be considered financial or investment advice. I know this is an ironic disclaimer to have on a video about technical analysis trading, but I have to cover my ass. In case you missed it, my name is Guy, and here at the Bureau I cover much more than just my ass. Cryptocurrencies, exchanges, promising projects, DeFi shenanigans, the list goes on. If it has to do with crypto, you can bet it's on my radar. If your radar looks like mine, join me at the Bureau by hitting that subscribe button. Hitting that notification bell will make sure you're up to date with the latest and greatest in the crypto space. If you're pressed for time or looking for a specific topic, feel free to use the timestamps below. Now, get comfortable and get focused, because what you're about to hear might make or break your crypto gains. If you haven't already noticed, this video is actually a follow-up to another video I did on technical analysis a few weeks ago. I recommend going back and watching that one first if you haven't already. I'll be waiting for you when you get back, don't worry. Alright, now that you know that technical analysis isn't just about arbitrarily drawing lines and have a few basics under your belt, I'm going to reiterate one important thing. For most of you, hodling is going to be just as profitable as trading in the long term. Unless you're willing and able to put some serious work into your trading strategy, I would recommend gritting your teeth and clutching your bags until the time is right. In both cases, however, you should be familiar with technical analysis. If this bull market has shown us anything, it's that fundamentals like use case, partnerships, and the strength of the team of a given crypto project, and even tokenomics, have basically gone out of the window. And as more and more retail investors pile in, the little amount of rationality that exists in the crypto space will become entirely undetectable. While your first thought may be that this inflow of inexperienced retail money will make markets unpredictable, you're only partially correct. Thanks to the predictability of human emotion on which technical analysis is based, this actually puts you in the perfect position to use the chaos to your advantage, assuming you do your homework, of course. This is because price patterns and technical indicators are going to become more powerful than ever in forecasting short-term price action as the public FOMOs into crypto. So, let's go through a few more of these and see how you can use them to get to the moon. Before I list out some more candlestick patterns, remember that the patterns you see can, and sometimes will, vary depending on the time frame you use. Trading volume should also be used to assess whether this pattern is strong or weak. Keep this in mind whenever you're scouting out those price patterns. One candlestick pattern you've probably heard of before is the bull flag. Bull flag consists of two things, the pole and the actual flag. A bull flag is drawn when the price of a crypto has shown a gradual uptrend over the medium term, but has started to see a bit of a pullback in the short term. The key thing to watch out for is a decrease in selling volume during this short-term pullback, because if the volume is high on those red candles, you might actually be in for a price correction. Once you've identified the flag, you have to find the pole. The bottom of the pole is at the low of the medium-term uptrend, and the top of the pole is where the short-term downtrend begins. Note that this means the bottom wick of the low candle and the top wick of the high candle. Here's where things get crazy. More often than not, the percentage change between the bottom and the top of the pole in a bull flag tends to be the same percentage that you'll see to the upside when the bull flag breaks. The breakout from a bull flag is usually signaled by a nice thick green candlestick. Bear flags work in the same way, except everything is reversed. A bear flag is drawn when price has been in a downtrend in the medium term, but has seen an uptrend in the short term with fairly low volume. The pole to a bear flag is drawn from the most recent high in the medium term to the candle which marks the start of the bear flag, and the percentage drop in price you're likely to see will again be roughly the same as the percentage change of the pole. The bear flag is broken when the first big thick red candlestick is shown on the chart. Bull flags, bear flags and their poles can be hard to spot, but are powerful forecasters of price when drawn correctly. The idea behind both is that a strong medium-term price trend will eventually override a weak short-term price trend. Again, the strength of these trends depends on volume. Wedges are another genre of common candlestick pattern. Wedges tend to be easy to spot and occur when two trend lines start to converge. When this convergence happens, price can either spike to the upside or drop to the downside. The reasoning behind wedges is that since price volatility is declining, it means that traders are uncertain about the direction the price is going, and it might be time for a trend reversal. Like flags, wedges fall into two categories: rising wedges and falling wedges. A rising wedge might look bullish at first glance, but almost always results in a drop in price. In contrast, a falling wedge signals a potential swing to upside. How high or low will price go? Like flags, this can be easily figured out by measuring the widest part of the wedge. The percentage change in the widest portion of the wedge tends to be the same degree to which price will go to the upside or downside when the wedge breaks. And of course, a wedge breaks when a candle appears that's visibly outside the range of the wedge you drew. This price action makes sense when you take a step back, because what's happening on the longer time frame is usually a return to the previous price levels. In other words, traders got a little too bearish or bullish and have moved back to what they believe to be a fair price for that asset for the time being. The last candlestick patterns I'll be covering today are double tops, double bottoms, and head and shoulders. All three involve support and resistance levels. Remember that where support and resistance levels are will be subjective and drawn by you, and you can use indicators like moving averages to get a sense of whether you're on the right track. Pro tip: support and resistance levels tend to be previous highs or psychologically comfortable price points, like even hundreds or thousands. Using Bitcoin as an example, 20,000 could be said to be a resistance level because it's both the previous high and a psychologically comfortable number where people might want to take profit. I digress. A double top pattern is drawn when price tries to break through a resistance level twice. This will look like the letter M. When this happens, it's common to see a drop in price that's roughly the same amount as the difference between the top and bottom of the double top. As you might have guessed, double bottom is drawn when price bounces off a resistance level twice. This will look like the letter W. This is a bullish sign, and the approximate move to the upside can again be measured using the distance between the support and resistance lines in the pattern. Finally, we have the head and shoulders candlestick pattern. This price pattern can be a bit tricky to spot. It consists of three price peaks which all touch or almost touch a support line at the top of a medium or even long-term upwards price trend. The middle peak is large, whereas the peak on each side is smaller. Note that these peaks do not have to be the exact same size. They just need to be noticeably smaller than the middle peak. A head and shoulders pattern often signals that the bears are back in town and price is about to fall. The degree to which price will drop can again be estimated using the distance between the middle peak and the support line of the price pattern. The moment you see a thick red candle, it's time to slap on that trend line and see how low you're going to go. Now that you're acquainted with a few more common candlestick patterns, it's time to break out the big guns, technical indicators. At the end of my previous video on technical analysis, I hinted that I would be covering the Fibonacci retracement indicator. You folks seem to like that idea, so let's start with that one. As many of you may know, Fibonacci, aka Leonardo Bonacci, was one of the greatest mathematicians who ever lived. He's famous for defining a mathematical pattern that is now known as the Fibonacci sequence. Without getting too deep into the weeds, the ratios derived from the Fibonacci sequence can be found everywhere, namely in music and in nature. Fibonacci ratios can be found in things like the shape of a pine cone and even the family tree of honeybees. Traders who use the Fibonacci indicator believe that the different levels on the indicator are natural levels of support and resistance. Now, while this may seem a bit arbitrary, many traders swear by it, and many of you have probably seen it being used by some of your favorite crypto personalities. That said, you might not find the Fibonacci indicator on your favorite crypto exchanges, and will have to go directly to the TradingView website to access it. So, what is the Fibonacci retracement indicator used for? Well, they're used to estimate the best time to buy or sell an asset, since each level of the Fibonacci indicator functions as support and resistance. To use the Fibonacci indicator effectively, you need to identify 2 points on the candlestick chart called the swing high and swing low. As you can see, the swing high point is where you see an obvious change in a price trend from bullish to bearish. The swing low point is where you see an obvious reversal from bearish to bullish. Once you've identified these 2 points, you draw the Fibonacci indicator between the swing low and the swing high if you're trying to see how low the price will fall, and you draw the Fibonacci indicator between the swing high and the swing low if you're trying to see how high the price will rise. Here you'll see a series of lines containing Fibonacci ratios. You might be surprised at just how nicely price action seems to cluster around these lines. As a general rule of thumb, the 0.5 line on the Fibonacci indicator is considered to be one of the strongest levels of support or resistance. Why? Because maths, that's why. This means that if you draw your Fibonacci indicator and see the price start to drop significantly below the 0.5 line, you might be in for some hurt. Likewise, if you see the price start to rise up near that 0.5 line, it's probably a good time to sell. Now, there is another very important technical indicator you need to know about that's often overlooked. That indicator is Bitcoin dominance. As the name suggests, Bitcoin dominance refers to what percentage of the total market cap of cryptocurrency is accounted for by Bitcoin alone. If you watch my video on how to plan your ultimate altcoin exit strategy, you'll know that Bitcoin dominance can be used to figure out when you should probably sell your alts. You can watch that video by clicking here. In short, when Bitcoin dominance is rising, it basically means that money is flowing from altcoins into Bitcoin. When Bitcoin dominance is dropping, it means more money for the alts. Keeping track of short-term trends in Bitcoin dominance can help you guesstimate when you'll see your Bitcoin or altcoin bags pump. Many crypto traders believe that this dance between Bitcoins and altcoins fundamentally depends on the price action of Bitcoin. When Bitcoin trades sideways, traders tend to get bored and start flocking to more volatile altcoins. But as soon as Bitcoin starts pumping, traders stop their shitcoin shenanigans and jump on that digital gold. And of course, when Bitcoin drops, it brings the altcoin space down with it. I should note that over the long term, Bitcoin dominance has been in a visible downtrend since 2017. This is logical, given that this is when we started to see a lot of altcoins pop up and take their share of the crypto market. However, there is another element at play here: greed. Most people are in the crypto space to make money, and the fact of the matter is that the biggest gains are not going to come from Bitcoin, they're going to come from altcoins. If you're a Bitcoin maximalist, you might be reaching for your inhaler right about now, but ask yourself this: do you want to be right, or do you want to make money? If you want to make money, you should at least consider shopping around some of the top altcoins. While Bitcoin is projected to see a 5 to 10x move during this bull run, many altcoins are going to see moves that are 20x or more, and that's a conservative estimate. At the peak of the last bull run, some altcoins were 50 to 100x higher than their price at the start of the bull run. You can watch my guide on how to find the next altcoin that could 100x by clicking here. In any case, this long-term decrease in Bitcoin dominance suggests to me that we could see unprecedented gains in the altcoin space, even among top altcoins like Ethereum and Cardano. This is fundamentally all thanks to the impressive Bitcoin adoption by institutions we've seen in the past year. This has proven to investors with much bigger wallets than you or me that cryptocurrency is worth throwing your money at. That said, investing in altcoins is much riskier than investing in Bitcoin, and it's ultimately up to you to decide how much risk you're willing to take with your hard-earned fiat. In any case, there is one more technical indicator I want to cover before we wrap things up. Have you ever heard of sentiment analysis? If not, you have now. Sentiment analysis involves analyzing a specific text to identify whether what's being said about a given topic is positive, negative, or neutral. Most sentiment analysis companies in the crypto space will analyze what's being said on Twitter about a specific cryptocurrency by analyzing a hashtag or a specific word or phrase. Some sentiment analysis tools even add more weight to what's being said by influencers like Ethereum's Vitalik Buterin and Litecoin's Charlie Lee. Others go a step further and analyze what the news is saying about a specific cryptocurrency, and likewise add weight to a news source based on how reputable it is. What's the point of all this sentiment stuff? Well, what do you think causes the price of a cryptocurrency to change? It's how people feel about it at any given moment. That's the whole point about sentiment analysis, to measure how people feel about something. The assumption is that emotions drive behavior, and, dare I say it, I think these sentiment analysis chaps may be onto something. It's pretty easy to imagine this cause and effect. You see some good news about Bitcoin, it makes you feel bullish, you share something to that effect on Twitter, and then you head on over to your favorite exchange to fill up on some sats before the price goes parabolic. Sentiment analysis could theoretically allow you to see this unfold in real time at a large scale. And you can then hop into the market earlier than other traders and use their sentiment as a measure of when to buy and sell instead of using price as a proxy, which is what technical analysis is essentially all about, measuring the emotions of traders by proxy. Unfortunately, most sentiment analysis tools in the crypto space are still fairly primitive. This is not surprising, given that sentiment analysis is a fairly new field, and developing the technology required to measure sentiment accurately is incredibly difficult. That said, I think it's only a matter of time before these tools are widely used. It's a good idea to have an extra set of powerful indicators at your disposal that not many people are aware of yet. I'll leave links to a few crypto-specific sentiment analysis tools in the description. You're welcome. Alright, my dear viewers, it's time to stick a hard fork in this one. The next few months of this bull market are going to be one hell of a ride, and, to be blunt, the only way you're going to truly maximize your gains is by familiarizing yourself with some common price patterns and technical indicators like those covered in this video. While I am a huge fan of fundamentals like a cryptocurrency's network activity, tokenomics, and partnerships, I don't imagine all the new people flooding into the crypto space are going to be paying too much attention to fundamentals. It's going to be pure emotion, and that means that price patterns like bear flags, bull flags, rising wedges, falling wedges, double tops, double bottoms, and head and shoulders are going to be your best friends. Remember that the strength of these trends will depend on trading volume, and what you see may change depending on the time frame you're using. Technical indicators like the Fibonacci sequence and Bitcoin dominance will help give some context to the patterns you've uncovered. And if you're a forward thinker, you can play around with some sentiment analysis tools to try and get ahead of the crypto market. While there may be no price pattern or indicator that can predict price action with 100% accuracy, I think we can all agree that we're headed for new all-time highs across the board. If you use these tools wisely, you will have a better sense of when to buy and when to sell. So practice, practice, practice. That's all I've got to say for today, folks. Was there anything that I missed though? Drop a comment in the description and I might just squeeze out a part 3 to this mini-series. If you enjoyed this video, be sure to give that like button a visit and drop by the subscribe button to pledge your allegiance to the Bureau. Pinging that notification bell will let you know when a new video is hot off the press. Can't get enough of crypto? Well, consider subscribing to my newsletter. In it, I cover just about everything you can imagine. In-depth crypto market analyses, important crypto news you might have missed, and much more juicy content that you won't see on this channel. You can subscribe to my newsletter using the link in the description. If you want to look really cool while watching my videos or reading my weekly newsletter, you can pinch some of this epic Coin Bureau gear for sale on my merch store. Link to that is also in the description. My next mission awaits, so see you on the moon, ladies and gents.